Hi everyone, this is Murugan. I'm a semi-registered research analyst. Happy to present another interesting video. I hope you must be an option trader. Or even if you are interested to learn options, you must watch this video. If you have a patience to watch this video without skipping a second, then you will have a serious takeaway from this video, because those insights which I'm going to share in this video with the back-tested results, that will always come on top of your mind whenever you form the option strategy. I hope this video can make that impact. In a way, you can stick to a system and you can sail through your option trading career. With that hope, let me get into this video. So as far as the flow of the content, I'm going to begin by explaining what is non-directional strategy and why do they exist, for whom it is really makes sense. And then I get into a few parameters from option chain analysis, because I hope it really helps while building those strategies that are needed to have a better returns over the market. And of course, as I said, I'm going to share some of the back-tested results which add up a lot to your confidence. So I can probably show you those samples and all the stuff as I move forward. But when you conclude this video, you may be in the position to answer these questions. If you are a beginner, you may be in the position to answer the first two questions, but if you are a pro, you can answer even the third question. But look at the first question. It's all about how do I understand the narrow range of the market, the Nifty. If you understand the likely range of the market, then you can build strategies on top of it. That's a very common question for any option trader. And if you know the probability, there is quite a good chance that you make money as an option trader. So these are all a common thing that an option trader should understand while building the strategies. I hope you can actually answer this question towards the end of the video. But if you know how to answer this video right away, if you are a master in answering this question, then you can probably skip this complete video. I humbly request you people to have a faith and patience, because I'm getting into this video hoping that you have a patience to watch in one stretch. Let's get started. What are non-directional strategies? We know the market sometimes makes a move on the up, sometimes it goes down, but sometimes it makes it slightly difficult to guess the direction, right? Let's say, look at the market here. It plays right at the resistance. By any chance, if I have a bullish view in the market, do you know what I do? I go and create long positions in futures. Sometimes I buy call options. Sometimes I create a bull call spread. But remember, when the market goes down, I have a downside risk, maybe a limited downside risk, maybe a premium what I paid is going to be the risk. But remember, there is a risk on the downside. So my bets were on directional, am I right? And same is true. Even if you have a bearish expectation, you create a positions accordingly. But here also we have a directional risk. Be it a short position, we have a risk on the upside, right? So if you are directionally good, then you make money here. But most often we see markets were clueless about the direction. We may not know what to do with the market because it's pretty confusing. In those times, still there is a way to make money. What we do is, we, instead of just buying a call or a put, we buy call and put. In a way, if the market goes up, I'm happy because of the call. If the market goes down, I'm happy because of the put. But as an option trader, even most of you must be aware of it. There is a risk associated, because the kind of premium we pay to get this position is huge. So market should exhibit a significant volatility in a given period of time. Only then we make money. So this, although it looks non-directional, there is a catch called volatility. I'll come back to the risk part bit later, but look at this now. Instead of creating a long position in both call and put, even if you create a short positions in call and put, still you make money on both the direction. So this is also non-directional. But in this case, you expect the volatility to be low. You expect the volatility to dry over a period of time so that you make money. If a market exhibits unusual volatility, or if a market takes one-sided direction, then you feel bad because there is a risk associated. Let me now come back to the risk part. When you have a long positions, if a market does not exhibit a volatility, you end up losing a lot of premium, of course. So there is a loss making scenario, but that's gonna be something which revolves around the current market price. But if you look at in this case, if a market hovers around the current level, you end up making money. But if a market exhibit a wider move, then you actually incur a loss. So where is the catch? It's all about volatility. If you're not directionally good, there is a way to make money through non-directional strategies. But here you need to understand the volatility. So the art of understanding the volatility is key for any option trader. I'm not getting in much detail about the volatility. Rather, I'm going to give you something which answers to this question. Even understanding the volatility is an art. Let's get into it. Okay. See, the market makes ups and downs, am I right? I have a question for you people. Now, I don't know how many of you people simultaneously watching this video. I humbly request you to go to the comment section and tell me whether from this level the stock is going to go up or down. See, I'm not expecting you to be right. I'm not expecting you to to do all this analysis. Even if you make a wild guess, okay, you may be right or you may be wrong. So market got either to go up or to go down. Sometimes it can even be stagnant. But if you look at the scenario, sometimes it goes up, sometimes it goes down. Some people make a guess on the downside. And anything market wish to do, it can do it. But when we look at our records by taking maybe about 5 years or 10 years or even 20 years, or even if you take 100 years, one common scenario which is happening, that most of the time market revolves at one level, which is the significant volatilities were shown at a very rare time. Most of the time market shown a less volatile scenario. Try to understand that it formed a kind of a bell-shaped curve. I think those who are familiar about the statistical concepts, through a distribution, we understand that's it's not a skews. It is something which is pretty much it's not skew, by the way. It pretty much works towards at the current level. When you understand this, you get to know how to define the trading range, because most of the time the markets will settle towards the current level, not much of the move. Of course, there is a tail risk which I come back with later, but if you're not able to understand this slide, don't worry much, because I have some working examples which makes lot more easier for you to understand it. So as I move forward, I can make you to understand this. At this moment, what I'm trying to tell you is mostly market revolves around the current level. That's what when you back tested for so many years. And this is not in the case of market alone. Statistically, such observations were pretty common in various aspects, as long as there is not much of skew. So this is the reason why even a lot of people makes a statement that market is also kind of random walk theory. All these bullishness, bearishness, it's slightly difficult to time the market. Okay, let's go with the notion. Let's move on towards to understand the things. But first of all, how do I understand the trading range? Some time back I said there is a bell-shaped curve. How do I construct this? Now, if you really want to know how do I construct this particular area, there is a pretty simple statistic concept which I'm going to explain now in a simple way. Okay, all you people have to figure out is, let's say the stock has a lot of move over a period of time. I want you people to take the average. If you want to take the average of returns, you can take it. If not, most recommended thing is to average average volatility. Okay, average move. So when you understand this, probably we call this as an average, or in a statistical concepts we say it is the mean, right? We call it as mean. So when you understand this average, okay, what you people have to do is with so many records, sometimes the market moves plus 1%, or sometimes it goes by minus 1%, sometimes it gains 0.5%, or sometimes it loses 0.5%, sometimes it gains 0.4%. With this may be Jan 1, Jan 2, Jan 3, Jan 4, Jan 5, Jan 6, and finally you get the average of everything. And with all those records, we can do something called a standard deviation. So that actually how much deviation from the mean. So that tells me how concentrated are they. Are they really towards the average? Is the average is something which is reliable? Is the market revolving around the average, or is it something which is beyond the average? Okay, now when you understand this, When you take one standard deviation, it covers close to 68% of the population. But I don't want to get in detail of the statistics, don't want to confuse you people, okay? Even if you are not understanding these concepts, needless to bother, because the real takeaway is from the next slide for the beginner. But if you are a pro who wants to understand the subject in detail, probably you should spend time here as well. So when you have a one standard deviation, we get close to a 68% of the population, okay? 68% of the population. And if you have a 2 standard deviation, it takes care of the wider range, of course. So there is a high probable case that it fall under your expectations. So remember, there is a 2 thing what we are trying to understand. The standard deviation is a probable range which helps us to define, like in terms of up and down. But Murugan, this looks so statistical, or this looks so theoretical. How do I do that as an option trader? Instead of doing this on a statistical way, I prefer to do this with option chain. That is where I believe an option chain analysis can help. From here on, this subject becomes more relevant to you and makes it much easier for you to understand. Thanks for your patience to watch this video till this minute. Continue this momentum. I hope you will find it much more interesting going forward. But Murugan, tell me, how do I find it? Okay, now just for an example, you take a future price. Okay, step 1. Okay, remember, step 1, you take the future price. Okay, let's say the future price is 1500. Okay, the future price is 1500, and I want you to understand where the at the money. Most likely at the money is around 1500, and it must be having a call option and it must be having a put option, of course. Okay, and this is something called at the monies. Okay, at the money, let's say the call option price is something around 75 and put option price is something around 77. Okay, when you add up to this particular thing, we end up getting like 150 152. Okay, this at the money range, you have to add upon from here, which is 1500 plus 152 and minus 152. Okay, if you do so, you end up getting 1652, and this is something like 1348. Okay, now you got a trading range. I hope you people got the trading range now. Okay, how do I got this 1650 52 and 1348? And this is just by taking the premiums, and it's a 1 round of premium on up and 1 round of premium on the downside, but I call this as a narrow range. Okay, now Murugan, with this range, what are we gonna do? Remember, I'm gonna share you some insights. Okay, I mean the back tested results. There are close to 64% chance. Okay, when you have 110% instead of 100%. Okay, if you put it in the percentage, it is 100%. Okay, if you put it 110%, okay, it's gonna be 68% chances are there that the market is gonna revolve around here. So having known there are 64 to 68% chances that the market revolves around, there is a pretty smart way to make money. Okay, for that you need to know what sort of risk to reward you have to take towards, because the tail end risk is also there. So, but if you really wanted to take a wider range, you can probably take 2 rounds of the premium. I mean, instead of taking 152, take another 152. So you will be having something like 1800 here, and here it's about 1200. So now it's around 1200 here. So for a market to settle between 1800 to 1200, pretty natural. Anybody, a common man, can even say it has a better probability. Am I right? But if you know the probability really well, only then you can even construct a strategy which can actually help you a lot. Hope this slide was much better or much easier than whatever you have seen it, but I can make it a lot better if you see some actual numbers. Am I right? So for that, what we can do is, I want you people to have a practice along with me, so that you not just see the video, you can actually practice it so that it remains with you. Believe me, you should actually attempt it. Even if you watch this video, you can pause this video, just take your browser and search this option chain filter. Okay, when you search this option chain filter, I hope the Google can list you various options. Okay, and the very first thing what you have is NSE option chain filter. I hope you guys can see there is something called NSE option chain filter. Okay, and I want you to actually click onto that particular link to get into it. Okay, let me do it along with you so that you can also catch it. let me take the browser here. Okay, let me take the browser here, and let me go from the Google itself. Okay, now if I go to this Google here, and if I go and say NSE option chain, okay, which is option chain filter. Okay, if I go to option chain filter, as I said, you see something on top of it. If you get into this particular page, it straight come into this one. The reason why I use the Google search, it gives you the right link on top of it. But even if you're familiar from our website, if you're someone who use the other scanners and filters, you can pretty much find that filter at NSE option chain filter. Okay, and if you see, there are a lot of parameters here, and this is not the video I'm going to explain each and every parameter. Of course, if you wish to learn each and every parameter, we got another video which was posted I think a month before. Okay, and if you look at that particular video from EQSIS, all you have to do is just go and search EQSIS, and I hope you guys can see this the channel here, and this is a video I hope this is the video I hope option chain filter with historical open interest chart. I think this video, if time permits, I'll add this card link on top of it. Okay, let's get into the chapter. So I'm going to focus on a couple of things here. Okay, now I'm going to focus on put call ratio, okay, which I come a later part of the video. Okay, and if you see, there is a plus mark here. Okay, this is a filter, makes it easier for you to to see the at the money call premium and at the money put premium. So I think this is a record which was updated as of 16th October, I think, as on Friday. Okay, and when I look at the ACC, the prices is 1,566, and then it is true the at the money must be 1,560, which is a closer one, and the call option price is 52 and the put option price is 46. So when you add up both, you get close to 100 rupees, am I right? When you get close to 100 rupees, actually 98, but on the round number I take 100. So if someone is asking me what is the range, okay, now I want you people to focus here. Okay, now look at the future price, 1566, okay, 1566. Now I'm not going to add up on to the at the money strike price. Okay, I'm going to take this range, which is 52 plus 46, 52 plus 46 with this particular one. Okay, so if someone is asking me what sort of move is expected for this expiry is 29th October. Okay, 29th October, and today we are standing at 16th October. So we have a close to 14 days, and we have a maybe close to 10 working days, in a way that the market is expected to be within 1466 to 1666. Murugan, this is any common man can say that. Remember, if you know that really well, then there are non-directional strategies going to help you to make money. But believe me, it's not going to be there for sure or forever. The probability of being inside is what I'm going to share you in the couple of slides. So I want you to stick to it. It's close to 68% chances are there for the market to remain in that particular one, what I said. Okay, and of course for you people, if you wish to pick up the Nifty, okay, now let me take Nifty. Okay, if you get into Nifty, you guys can have a Nifty and Bank Nifty in one filter, you can get it. And if I take 22nd October, you see the premium is 119 and 103. I think adding up I get close to 120, am I right? So if you look at this range now, which is market is 11,765 with 120. So if someone is asking me the range, I see the range is something 11,600 to 11,900, and the probability of market being inside is close to 68%. Okay, it's close to 68%, and there is a second level of standard deviation which I can talk about it. Let me slightly get into the the chapter. Okay. I think this slide may be pretty confusing. Before I get into the slide, let me share the raw data what we have in the Excel. Okay, I hope you guys can see this Excel sheet. Okay, and I hope the text is also visible. If not, because we probably take efforts to record this in the HD version, if not in the 4K, but otherwise you need a stable internet connection to see the text well. Okay, now look at this. The point number one, I said it is a back tested from 2015. I hope you see this is Aditya Birla Nova, the contract expiring on 29th Jan, and if I put it on the the timestamp here, you see it's a 1st Jan 2015, and if I go down, I think for a 1st Jan 2015 we must be having a a close to 150 or a 200 records, because every future contracts been evaluated on this ground. So we wanted to know what happens to these future contracts. Sometime back, if you see, I was telling you people that market tends to be within this range, right? I told you sometime back 11,900 to 11,600, but you may be questioning me that, Murugan, even last 2-3 days the market witnessed unusual move. Is it really true that the market settles within this range? That's why I said there is a probability of settling within this range is only 68%. So you should know, okay? But for that we need to back test it, of course. Am I right? For back testing it, just for your a confidence, just to build your confidence, I'm gonna share you something that when you see that, I think you guys can also go and see through NSE website to verify these numbers as well. Like the future prices on 1st Jan 2015 was settled at 1699.8, okay, and if you look at the call option premium, of at the money, okay, which is 1,700, call option premium is 50 rupees and put option premium is 53. In a way, we see the collective premium is 103 rupees. 103 rupees is a collective premium. So as per my statement some time back, the market movement is expected to be 1,700. I just rounded it off for the convenience, okay, 1699, rather it's rounded it as 1,700 plus 100 points and minus 100 points, which is 1,600 to 1,800, okay, 1,600 to 1,800. Let's see where the market settled on the expiry day. If you look at on the expiry day, on the expiry day of this contract, the market settled on 1,823. In fact, it went slightly beyond the 100 points move. Okay, how much it went beyond? It actually, it settled at 120%. It went beyond the 100% of the move. I said 100% in this case is 100 rupees. Okay, but in this case, that's why the at the money premium is 104, but the market exhibited a movement of 123. I'm not talking about the range, I'm talking about the market settlement towards the close, where exactly it finds the close. I'm not talking about the highs and lows. In this success ratio, we are talking about the close, okay? Because I'm going to recommend you a limited risk strategies, not the unlimited risk strategies to bother about highs and lows, okay? And by the way, just for you to gain some confidence, look at this. This was on June 2015. When I scroll down, you guys can see it's November 2015. And you guys can see it's on 2016 and it is 2017. So if I scroll down, you guys can see 2018 record. Even if I just randomly take it, okay, let's take a company which are pretty familiar. Let's say Axis Bank, okay, 28th March 2018 contract, okay, 28th March 2018. This is an expiry date, and if you look at the date, 26th March, the future price must be 553.35. Just for you people to understand the integrity of the data I'm presenting you, okay? And what I really want to convey out of this particular Excel is the sample size is close to 2.3 lakh. So 2.3 lakh of contract incidents is a meaningful sample for any statistician to agree upon. And we see a very common behavior out of this. Okay, Murugan, what exactly you saw out of this? Okay, now look at this now at the last slide, what you see. Okay, let me hide another component which I really don't want because it's pretty much distracting for most of the time, am I right? So what I'm gonna do is, I'm actually going to take, I'm just gonna hide it. Okay. Okay, till this, okay, and let me hide it, okay, so that it's pretty visible in this one slide. Okay, now you see that the future price was 1699, but the market made a move, okay, okay, now look at this. Thanks for the patience and sorry for the gap in between. I hope you appreciate. Meanwhile, why not you'd have gone for liking the video, and why not you can even subscribe it. Of course, you must be an existing subscriber because you see that. And if you are an early viewer of this video, do share this video, because when you watch this video early and if you share this, Google even like it and YouTube will start recommending us, and that motivates a lot. Okay, quickly get into this video. Okay, look at this. I said the future price is 1699. Okay, and if you look at the money premiums, it's 104. Okay, that's the first one you have to remember, and the second thing what you have to see is 104. But look at where the market was settled. It's 1823, which is 123 rupees movement from this level. 123 rupees movement from this level. But when you look at this, the market was 123 rupees movement, whereas out of 104. So the market made 119 percentage of that. Like in this case, 3 rupees, whereas the market made 7 rupees of move. Okay, but in this case, and it witnessed on the downside. Okay, it witnessed on the downside, because if you look at the market, future price was 135, but market settled at 122. Market settled at 122. So we know that sometime market settles within this range. Market settles within this range. Like sometime you see it is like lesser than 24. In this case it is lesser than 17. In this case it is lesser than 16. In this case it is greater than 13. Sometime it is greater, sometime it is widely greater. Am I right? But we want to know how many times out of this 2.4 lakh sample, because we should not be excited by seeing one or few attempts. That's why often I tell people, don't judge your system, don't judge someone's system just by looking at limited sample. Of course, that's a very common statement. So I just want to tell you people on this one, I think that's a pretty advanced PCR now. Let me take that out. So if you look at the overall sample, I hope you guys can see this bell-shaped curve. Okay, now this bell-shaped curve is not something as my invention. It's just after all the discovery. Okay, and thanks to the bell-shaped curve, because this is pretty common behavior, since it is also happening here, that add a lot to my confidence. So look at this. What exactly means to me with this? Okay, now I'll just do this calculation for you. Let me do this by taking this. Now I'm dividing this 2985 divided by this. Okay, don't worry about this Excel formulas and all other stuff, pretty irrelevant if you are not familiar about this Excel. Okay, let me tell you what it is. Okay, now I'm going to divide this. Okay, now look at this. The reason why I do everything right in front of you people is probably that add up a bit to your confidence, right? So we thought of doing it along with you people. Okay, now look at this with this back tested. Like there are 18,000 times, okay, the futures, the market expired slightly below the current market price. That's what this 18,000 indicates. There are out of at 2.4 lakh attempts, okay, I think precisely saying 2.34 lakh, it's 18,000 attempts were marginally settled lower. There are 16,000 times it's settled a 50% of the premium. 50% of the premium. Okay, but then what do you mean by this? A 50% of the premium. I said at the money call premium, at the money put premium. Let's say if it is 100 rupees, market settled below 50 rupees. Market settled below 50 rupees. I hope you managed to understand it right. If not, have a patience, don't give up. Just see this video maybe about again 10 minutes prior to it. See this video again. If not, take a break, watch this video by tomorrow. You can save this now to watch later, or probably you can bookmark it, or you can schedule yourself to watch this. But do watch this, and you have to watch this throughout and you will find it pretty interesting. Okay, now get back to the subject here. And you see that it is a pretty common behavior for the market to settle around at the current level. I think if you are familiar about the statement, mostly market revolves around the range. Market exhibit the range bound behavior, and this is the proof for that. Okay, although the market witnessed the volatility, it was not most of the time. Of course, these are all the ends. If the market goes, we lose money, of course. Okay. We call that as a tail end risk. Okay, now let me go back to this. If you ask me in this video, that's what actually shown here in this. This is what shown in this particular video. I think I should be having this particular thing. Okay, now look at this. Let me calculate this. 110, okay, I'm taking this 110, okay, till this 110, okay, 110. When I take everything, the sum shows here, which is 68.3%. I look at my mouse, okay, this is something which I can't zoom, okay, but I'm actually showing at the bottom of the screen. I hope you guys can see there is something called 68.3%. By adding all this 4.3, 5.7, if it is interested, you guys can take a calculator and add it. You get to know it's something 68.3%. So out of 2.3 lakh, there are close to 1.6 lakh times the market revolves within the premium. With this fact, you should gain confidence. At least you should believe it. Most of you are aware of this concept of at the money premium, but with this you can believe it. Probably you can start working on it. If not this time, next time it can happen. Most of the time it is happening. See, as an option trader, don't build a strategy which works once and 9 times it goes wrong, because it tests your patience. Better build a strategy which works 6 times or 7 times out of 10. If you have a success ratio close to 60 to 70, that gives a lot more confidence when you build a strategy. I think this is what that record says. So if that is the case, what strategy do I need to build? I hope by this time you got it. Let me tell you what is wider range. Okay, let me tell you what is wider range. Okay, when I'm talking about the wider range, I'm trying to cover something called 150%. Okay, 100% of at the money premium is the narrow range. The wider range is something which I'm talking about 150%. If I take this study of 150%, I have to take it from here, which is from this 150% on the negative or even on the upside. So I'm not bothered about the direction. I already told you, be it upside or downside, I have 150% cushion. Okay, now if I take it, you see something close to 83.4%. Okay, now forget about the round number, close to 65% and 80%. I think that's fair minimal expectation. One has 65% you expect it to be right, and 80% you expect it to be right if you have a wider range in the market. But Murugan, how do I see this wider range? How do I get this wider range, Murugan? Can you give me one more example? With that, let me, doesn't matter even if I stretch the video, let me give you this example. Okay, now look at this. How do I get the wider range? Now, if you ask me what is the wider range here, which is 11,765, with this, if you want the wider range, as far as our backtesting is concerned, which is 150%. So if that is the case, like the 250, it's close to 220 into 150%, 220 into 150%, which is close to 330, which is nothing but 330. So 330 on top of it, which works out to be 12,000, and 330 on the downside, which close to 11,430 or odd. Okay, I think the market got 80% chances to get expired within that range. I hope you got some meaningful idea. If not, just crawl back for about a couple of minutes and watch this again. You will get it. Let me quickly get it further concepts. Okay, now with this, what you got it? At the money premium has lot to convey in terms of probability. If you know how to build a strategy on the narrow range, okay, you go ahead and form it. But if yours is a narrow range, make it about 100% and believe that your success ratio will be close to 65%. Accordingly, you plan your risk to reward. And if you are constructing something on the broader range, you get a better success ratio. Okay, you got a better probability, but make sure that you get a reasonable risk for the returns. Okay, but for that you need to understand the risk adjusted returns for that. But understand one thing, sir. Although we have the success ratios are in our favor, there is a tail risk. Sometime market can go 3 to 4 times away from that. Those scenarios can wipe you and me out of the picture. So always mind your risk. I think when you really want to play it, it's good to have a partly hedged strategies or a fully hedged strategies when you actually bet something on non-directionals. Okay, but you have to, even if you have a marginal returns, okay, that's far better if you have a piece of maker, because you see there is a tail risk. Of course, you see there is a tail risk. Most of the time below 300 there's a significant contributions where, or beyond 3 times of this, a significant contributions were there. Okay, now I hope this range probabilities were pretty clear for most of you people. Let me actually go and in terms of just summarizing that particular thing. So you now by this time got most of the time the markets were settling within this trading range. Now you should form a strategy. I hope I've already explained you in terms of how to pick up this narrow range and the broader range. Of course, if you want to pick up 2 times of the premium, it gets even wider. In that case, the success ratio tends to be more. But if you build a strategy for a very wider range, you get a peanuts. Okay, so there is a trade-off. Do I need to be with 1 or 1:5? That's an art. I hope you get a lot of these content as we move forward as well. Okay, with all this finding, what are we gonna do? Okay, let me tell you one thing. You can build a strategy like iron condor, or you can build a strategy like butterfly. You can build a strategies like straddle and strangles. But remember one thing: if you build a strategies, okay, if you build a strategy which is, let's say, if it is a straddle or strangle, there is a tail risk. Okay, when a market exhibits a larger move, although it's maybe about a 4% or a 4% or about less than 5%, but those 4% should not wipe you out, right? So you should mind your risk really well. So if you're really pro at handling your trades, then you can actually go at straddles and strangles. If not, better be with a butterfly, which is a fully hedged, right? A fully hedged strategies. So it's better be with a and by the way, this is not the video where I'm going to explain you about each and every strategy. For that, with relevant to this particular way of trading, we may come up with few, but otherwise you can go and check out our previous videos we have posted in the channel. Okay, and iron condor, maybe it's a fully hedged strategies. I think you should probably work an either of iron condor or a butterfly. But if you're a pro who know how to handle straddles and strangle, then of course with this you will definitely gain probability. Believe me, by this time you should have got some insights. But to retain it, okay, you should practice it. Because just by seeing or watching a video doesn't mean you get everything. Of course, this is where you got something, but you have to practice it. Okay, for that I request you every day you guys can even figure out the trading range of the market, and you can actually document it. Okay, and if you're a pro, you guys can actually do a back testing of those things as well. Okay, so but the point is, do I need to be a long it with iron condor or short with this? Long or a short really depends on the risk to reward I get it, because we know the probability. Okay, we know the probability. Okay, we know the probability, but the one more thing is risk to reward. Am I right? Risk to reward. Risk to reward. That really depends on the current prevailing premiums. Okay, the current premiums. By any chance the prevailing premiums were not offering me the expected risk to reward, better I don't go for a long, but rather I can go for a short. So I think mostly we go for the iron condor or a short butterflies. I think various ways by which we can actually make money, but you should be really good at understanding to be with long or a short by understanding the probability and risk to reward. But I think that altogether it's a lengthy video which probably I can dedicate to another video where I can tell you with what probability or what risk to reward to decide a long or a short of these strategies. I think that itself gonna take probably a 1 hour video. And by any chance, if you feel that Murugan, the video looks good but something I'm missing, maybe because it's not you are interacting with me, you are not having a conversation with me. I think prior to this video, a lot of you people having watched my video, you guys somehow I think you guys can get my phone number even through a lot of you people are calling maybe through me or to our executives. If it is a one-line question, maybe you're a client or not a client, we will definitely answer your question. If it is one-liner question, in a moment if I can answer your question. So feel free about calling us if you have one-liner question. But if you have a pretty lengthy question, if you have something more to interact, of course, we can't answer everyone's question over the phone call conversation. For that, we have a dedicated training program. So let me just take you through, it's not going to be much. Then I'll take you through the put call ratio, but let's just give you something. Okay, we have an online training program. I hope you guys can see the couple of one which is option trading strategies for the beginner. The other one is option chain analysis for the pro. Okay, and we primarily recommend most of you people should fall in the category of the beginners, because if you get the fundamentals really well, only then the pro level program makes sense to you. So don't get excited or curious to go to a pro level straight away. Better you actually undergo the beginner level program and have a patience of practicing it really well before you get into a pro, because with the wisdom what you get in the beginner, you understand the pro really well. Okay, but what is the advantage of taking this particular program? Of course, we charge a fairly low when compared to the market, not because the program is short. Rather, we see this our program makes much more sense of the pricing is something altogether different, and we have a limited audience. Okay, we have a very limited audience. In a way, you get a time to interact. Okay, there you buy our time and we go for a conversations, and there we are not there to deliver what we have in our mind. When you look at this video, I'm delivering something what I have in my mind. But when you look at the when you really look at a training program, when you really look at a training program, we first look at what is your expectations, accordingly we deliver it. So of course we have ongoing sessions, you guys can find the slots, and if you're interested you can definitely go for it. If you're taking a pro level program, there is an eligibility test you have to undergo, and then you will be eligible. What am I trying to convey here? When you take up a training program, our school of thought gonna be same, so that helps us to have ongoing conversations going forward, and that makes me to answer in one line going forward any of your questions. And there we find lot more time to have the interaction. There we find a time to understand you, to provide a support for you. That's the reason why we have a limited session. Just because online we don't have hundreds of people or 50s of people, we're just going to have a 20, max to max 25, and we make sure that everybody gets a chance to understand the content. Okay, let me go along with the content again. I hope this non-directional strategies gets better, but now I'm gonna give you some directional bias using a put call ratio. Most of you must be familiar about this, am I right? Most of you must be familiar about this put call ratio, very popular one. Okay, and the general understanding is, if you see a lot of put, if you see a significant put over a call, okay, if you see a significant put option, then the market seems to be oversold, the market. So in a way we see the slide towards on the upside, and if you see a significant call options, and we see that's the general notion of put call study, right? If you have a significant call options, okay, with the writers were in place, we see the price to go down, and if it's a significant put options were already on the open interest, we see the put option, the price tends to go up. But we wanted to know, does it really happen, right? So when I go back to this, you may be interested to know. Okay, if you look at this particular record, okay, if I unhide this, okay, if you are curious to see what exactly this spreadsheet all about, okay, you might have seen our scanner, right? Sometime back I was showing you a scanner in our website. I think this is a scanner. You see that if I take a stock which has significant call option, okay, if I take a stock which are trading with significant call options, you see the list here. Okay, but I wanted to know what happened to this stocks as on that expiry. So any scanners what we have, we should try to optimize the performance, right? And then we as a research team, we wanted to learn by seeing what market really ready to teach us. So look at this. We have documented this. Okay, and this helps us to know what works under what market condition, of course. So if you look at the significant call options and put options, now I'm going to focus on this. The rest of the conditions probably we see in other videos or sometime later. As far as this video is concerned, I just gonna take a put call ratio. Okay, if I take a put call ratio, you guys can see that it's not every time we get this filter. Okay, there are few instances, like on as far as the Amtech Auto on 2015 exhibited, okay, the significant call option. If you want some recent record, let me go down and make you to feel better. Okay, if I go down as of like maybe if I go down and if I see this record, okay, if I take this record, And if you look at significant put and call option, okay, significant call options, which as of 8th of November, okay, 8th November of 2019, okay, let's take 2020 record. Let's take 2020 September, or maybe like, a couple of page up, not to waste much of your time. Okay, let's say 18th September. 18th September, significant put options. Which company? Let's see which company it is. Apollo Hospital. Okay, on 18th September, if you want to verify, go and check. The price must be 1831. The future price must be 1831, and at the money price is 1840, and the call and put price of 1840 is 34 and 44 respectively. Okay, and when I look at the put call ratio of taking all the open interest of call and put, it was suggesting us there is a significant put options. Okay, it was a significant put options, but we need to know whether does it really move up or down, right? But in this case, the market managed to go up from that level, because the day when we have studied that was 1831. The day when we studied the market is 1831, but on the expiry the market was 1941. So the market really went up, in fact, which is 110 points, whereas the premium was only 79 points. It, in fact, beyond that, the range, what it really happened. When you form the strategy, you might have lost money, but remember one thing, that the most of the time that the record shows, it is settling before. So that's the reason why people, with lack of system, lack of data study, they don't stick to a system. That is the common reason why people miss out these strategies. They lose confidence on it. Okay, now coming back to the put call ratio here. Okay, let me go back to this, and I'm gonna delete this. Okay, and I'm going to just introduce one component here, okay, for you people, just to understand it better. I'm going to introduce, I think if those who are familiar about this pivot table will also agree upon this, whatever I'm doing it. I'm actually going to take this a put call ratio, which is PCR analysis. If I take this PCR analysis on top of it, you guys can see something like this. Okay, now remember, if I take call option, look at this. I want everyone to pay attention here. This is a call option. If I go to a put option, okay, you guys can see a different skew. Look at this. Can you see there is a change in skew? Just see that it's going to change the skew. Look at this. It is going to shift slightly. If I say significant call, the skew is going to be towards the left hand side, towards the negative side. Look at this. Towards the skew is towards the left, and if I take this particular one towards the right, you will not be seeing a drastical skew, because market follows some efficiency. So if it is a drastical skew, of course the contrarian player will start coming into the picture and takes the opportunity, and it actually makes the market to revolve around the equation. So even if you find any technical concepts, by nature it will not be right by 80 times or 90 times. Try to understand, those things will revolve around the mean, but you see a marginal difference. So your system may be right by 55 times, 60 times. In a way, that system is doing fairly better. If you believe that, if you want the system to be right 80 times, 90 times, directionally, I think your expectations were not fair. Okay, even on this grounds, if you look at the put options and call options, okay, now let me put on both in front of you. Then with the difference in the color, you guys can see. I want everyone to be patient to watch this. The orange color, what you see, is actually higher than the blue after the positive ranges. Look at the positive, 10 to 20, everything is positive. This is all minus 30 to minus 11, minus 70 to minus. In this case, the blues are quite higher. Okay, now let's understand what is blue and what is orange. Okay, when the call options, if the significant calls were there, then it ended up mostly on the negative side. If it is qualified as a significant call, it was ended up in the negative side. If it is a significant put, then it is ended up on the positive side. So I think it actually fairly gives us a clue. So by any chance, okay, now look at this. By any chance, if you have a stocks, I think this is as of today, 16th October. I'm recording this maybe around 9 or 10. By the way, remember, we have already posted the same video, but there was a lot of issues. I messed up something with the mic, or something went wrong when we have converted this video. So I'm redoing this video once again. All this happens in one stretch. And it was last time the video was about 50 minutes. Again, I'm recording this video once again for the 50 minutes because a lot of our subscribers given me a comment stating that it was a noise, the voice was not good. So when I am taking an efforts not to come up with this, you can also contribute back to EQSIS. I humbly request you people, why not you guys can share this video. When you watch this video, find some sense out of it. Do share this video and you express yourself by liking it. If you watch this video till this minute, you might have found some sense to it. So why not you instantly, not just liking it, do share this. When you share it in the WhatsApp or a Facebook, we generally tell the people, but it rarely happens. When it happens, it makes wonder to us. Help us. Okay, now let me tell you in this case, a significant call options. Look at these stocks got a better chances of slightly closing lower range. I mean, lower doesn't mean it is going to be negative. Although it is, look at this, although it is a significant, look at this one, although it is a significant call or significant put, mostly, look at the break even, mostly market revolves around -10 to +9. I mean, -10 to +9. The market revolves around this range. That's a fact. It means what? Although it is bullish or a bearish, most of the time market doesn't make much more. That's the key takeaway. So even if it is a positively positively biased or negatively biased, don't underestimate the current level. That is the reason why in any of our trading strategies we give a more important to the theta. So at the current level, if the theta is in our favor, most likely you end up making money, right? That's why a lot of people say option writers makes money. It's not option writers are pro to make money. Option writers got some statistical advantage, the reason why they make money, but they do lose money when they see the tail end happens, tail risk happens. So you should know how to manage your positions as well. Okay, coming back to this, look at this. In this case, it is negatively skew because it is lot of call option, and in this case it is positively skew because it is the put option. Okay, but don't form a bullish or a bearish strategy. Do a non-directional strategy with some directional bias. How do I do that, Murugan? With PCR directional bias, if you understand this, the last 10-15 minutes, what you guys can do is, instead of forming a butterfly, I think the butterfly is this, I hope this is the butterfly, am I right? This is the butterfly where we have a kind of risk and some good returns if a market settles within that particular trading range. But why not, if you see a significant put option, if you see a significant put option, then the market tends to go slightly on the upside, then probably you keep this as a marginal profit or a no profit no loss instead of taking a risk, because it is quite a good chance for the market to settle in this range, or probably you can adjust the shift in a way to make money. This is a modified butterfly. Okay, as I told you, I'm not going to explain about those strategies, but if you are not even familiar about these strategies, you should definitely consider the beginners level training program. And of course, we make this program also fairly interactive and affordable for you people. And of course, we have some coupons for you people to attempt it. Okay, now let's go back to the quiz. Okay, the moment I say something to practice, people see it as a conclusion, they don't proceed further. Okay, let me tell you one thing, unless otherwise you practice, what are you gonna retain it? Okay, now here's the first challenge. Okay, I want you people to go to Nifty now. Okay, go to Nifty. Okay, go to Nifty option chain. Okay, go to Nifty option chain and find the, okay, by the way, I believe you guys can see this video anytime. You guys can see the video by 2021, 2022, anytime. I see this is evergreen concept. So anytime you go and see the option chain, okay, that particular day, tell me what is the at the money strike, okay, and give me plus ATM and minus ATM and try to answer this question, and tell me what is the narrow range for that, for one round of premium, one at the money premium or minus one at the money premium. Okay, and if you are a pro, I recommend you to reply me in the comment section, or you can also suggest other people response. I try to respond, but I can't, I alone cannot answer everybody's comment. So if you take an effort, we can actually work on it. Okay, here's the second question. I think this question got the answer in the video. So this is a question test your understanding of throughout the video. So the answer is already hidden inside this video. If you're unable to answer this question, you have to rewatch this video again. Okay, the probability of settling the broader market, broader range, I mean 150%. okay, and which is 65% or 81%. I think it's 81 and 65 is just rounded up number, okay. It's 65 to 68, even if it is okay. 81 to 85%, it's something in between. But I want you people to answer this, okay, as a matter of appreciation, okay. Instead of just leaving without answering it, why not you go below in the comment section and answer the question, okay. And here is the advanced question. If you're a pro, okay, if you know how to form option trading strategies, I already told you to create long or short. I think this question was really important for you to answer it. When you have a 65% success ratio, when you have a probability of being right is 65%, what should be the minimal risk to reward for you to break even? What should be the minimal risk to reward for you to break even? Okay, for that, if you know how to answer it, it's fairly good. Otherwise you guys can expect my answers after a while, maybe about 1 or 2 weeks. Before that, I hope some will answer that, and a lot of you people can even comment that or probably like that, so that it gets on top of it. Hope you find this video fairly good. And if you really wanted to practice some strategies, okay, I can still recommend you to I can definitely recommend you guys can go to something called we have something called Primer, and you guys can log in. I think this is a portal specifically for building option strategies, like okay. Now I hope you guys can see this portal. I think it's fairly interesting portal. If you get into it, like, so if I say Axis Bank, okay, I think Axis Bank is, I think as of okay, now Axis Bank price is 473, am I right? Axis Bank price is 473 as of today, and you see that the chart here. And of course, for you to understand the trading range, if you scroll down, you see where the maximum open interest. This is all general option chain analysis. And if you look at this 32 rupees range is there. 32 rupees range from here, it means close to 510 on top of it. So I have a 510 on top of it resistance, and the price action also says 510. Look at this, the 473, the price action also 510. There is a resistance on downside. The support, it's not a support, the trading range, the most likely range for the market is below 32 points, so which is around 440. So 440, I think if you look at this, the market is expected to be 5 at this range or at this range. Accordingly, you guys can express your opinion, and you can submit your strategies, and the strategies whatever you have submitted, okay, and you guys can even build strategies. You can look at other people's strategies as well. You can even form strategies for other people as well, okay. Like if I think I've got someone posted on ITC, I can actually go and build strategies. And I know that ITC is something which was trading around 166, and the premium may be something close to if I want to be right with in front of you people, so never be lazy of doing something. So let's do it along with you people. Now the premium is 3 to 4, close to 7 or 8 rupees premium, am I right? So 8 rupees of premium. So the trading range is something which is 8 rupees on up and down, 172. So if I sell it as 172, what I can do is I can sell this 172 call option. I can sell this 8 rupees 172, which is 6 rupees here, 160. So this put option, of course, there is a wider range, that quite a good chance we get money of making this particular one, and we probably lose money if a market goes beyond this range, right? Okay, remember the chances for us to lose money is there if a market goes beyond this particular range, but you need to know what is the probability of things going beyond. So you need to find the break even. You get the break even, negative break even, positive break even, all these things, what maximum profit you guys can do, everything. Of course, this helps a lot for you to interact with us or interact with our other audience. So hope you find sense in this particular video. But to really add up your confidence, remember one thing. Instead of believing in your instinct, you better go with numbers, okay, because this is a sample size of close to 2 lakh things, so better go with that. But before you execute your trades, do your research as well, okay, and if you're convinced only, then you trade. If not, it's the trading risk appetite solely belongs to the viewers, okay, and not just as a disclaimer, and it should be fair. And most importantly, okay, now I just want to share something. The incident which happened last time, in our, I think there was a gentleman who called me and he asked me to watch his WhatsApp status, And I was surprised to see his WhatsApp status. It was a link. Okay, I think it was a link, and that was a link from our the previous video. I remember. I think that must be this video, which is the video what you people are seeing it. I think this was the video of this one. Okay, and because here you see something which is the very different option chain analysis, which is if you look at this particular one, which is a multi-dimensional option chain analysis along with the price. And he was looking at this particular tool for a very long time, and there was close to, and I think he must be someone who's even conducting the training program for, he has a lot of followers too. And what he said is he kept this link in his this video link in the WhatsApp status, and that made us to see that a good number of people started finding it easy. Remember, such activities motivate us a lot, because when you find something good, you should express yourself. That motivates and that makes us to work. Remember, it was I'll tell you something which about a few minutes before, I think you see that the 3 hours before we posted this video already. I hope you guys can see this. There is a video been already posted. This video was what I'm recording has been already posted. Okay, and I'm gonna redo this. And a lot of people gave me a feedback. Could not enjoy this video. I hope you guys can see. Because the audios were not clear. Am I right? So I really appreciate have done analysis. Wonderful topics for past 6 years. Okay, now I think some of you have got some feedback. Probably excellent, but poor video, poor audio. Am I right? So the idea is, please record this video once again with a better mic. Okay, now I have taken efforts to record it again in a matter of 3 hours. I hope you guys can see this is just a Google timing. Am I right? In a matter of 3 hours, I have taken a video, to post it. So in this comment, I'm gonna put it in the link also in the upcoming video, and we're gonna delete this particular one. But remember one thing, you should also support us by sharing the video. If we see just about hundreds of views or thousands of views, does it really motivate us to come up with another video? So I want you people to fairly support us in terms of, you may be better than us in terms of helping us to find a better views. So I leave it to you people just to motivate us. Thanks for being till this minute all the way. Hope you find a better trades going forward. Thank you. Thanks for joining us.